Hey, so welcome back to the Hey Ed YouTube channel. I am your host, moderator, and all-around nice guy, Edward Anderson. I'm not a financial advisor, so do not construe anything that I mention in any of my videos as financial advice. Always do your own research before doing anything with your money. Today, I want to talk to you about something that's very important. This is a topic that really is not getting any kind of coverage by the mainstream media. You need to be aware of this because it could dramatically affect your finances, your trading, and your lifestyle. And I don't want you to be a victim of it. And God willing, maybe you can even benefit, prosper from it. And I really hope you watch this video all the way through. I mean, I know YouTube audiences don't have very much patience, but please try to make an effort to watch this all the way through and even share this video. And if you don't mind, could you support my channel by hitting that like button, the subscribe button, and ringing that notification bell? All right, so a lot of people right now are, I think, very complacent about the market. I mean, after all, let's take a look at what the stock market has been doing. Okay, so I'm recording this video on Wednesday, May 28th, 2025. The market's been open for about 45 minutes here. So at the moment, the market's up 11 points today. Now, this is the 1 month chart. Let's go back a little bit. Here's the 3 month chart. Now, you can see that, last month we had that really big, nasty scare in the market. And since then, it has pretty much recovered all of that loss. Now, of course, these gyrations is primarily due to this whole tariff kerfuffle. And I won't go into that here. I've covered that in other videos, and I want to respect your time. But for our purposes, let's just say that the markets, in aggregate, seem very complacent. They're very happy. The markets don't seem to have any worries in the world. Everything is right with the world, right? Now, in my opinion, this is the proverbial lipstick on a pig. There are a lot of very big problems, lurking right under the surface of the water. Now, I have a trader's mindset, right? Which means I'm always looking over my shoulder, okay? I'm never complacent. I'm never happy with what's going on. I'm always looking for the potential black swan event that could, turn the boat over. And in this video, I want to talk to you about one of those potential big black swan events. This is a topic that I have talked about before, but it bears repeating because of what's going on right now. And that is regarding the bond market. And if what I think will happen does happen, it will affect everything, every aspect of your life. And probably most dramatically, it will affect the survival of the US dollar. Not just the US dollar, by the way. I just mentioned the US dollar because it's the headline currency. The truth is, this will affect fiat currencies throughout the world. So if you're watching this somewhere in the UK or somewhere in Australia or somewhere in Japan, please watch this because it does affect you too. Okay, so by now you're saying, all right, Anderson, just get to it. All right. Now, again, I'm going to go through some of the details pretty quickly because I just want to set up the main message. So let me paint a little picture here for you because it is relevant. It is important. And the feature of this video is the global bond market. Now, the global theme right now in the financial markets is to sell America. That's the buzzword that Wall Street is using to describe the phenomenon that's going on with U.S. debts. So last week, we had a very disappointing U.S. Treasury auction. The appetite for U.S. Treasuries just weren't there. I mean, this is not like the old days where these auctions went off like a hitch. Everybody scrambled for Treasuries. I mean, so what happens when you have a product that you're trying to sell and you perceive it to be a good product, so you put a price on it, but nobody goes for it? What do? You have to make the sale of the product more enticing. In this case, in the bond market, they raise rates. So remember, there is an inverse relationship between yields and the price of the bond. Think of it as a teeter-totter, okay? As the price of bonds go down, the yields on those bonds go up, and the converse, right? So there's that teeter-totter effect. So that is why you're seeing the interest rate on the 30-year bond inching up. And this is a key metric you want to keep a close eye on, because as interest rates go up, that indicates bad news for the underlying bond market and the economy, and everything else that's related to interest rates, your mortgage, your credit card payments, your way of life. So here's the action in the 30-year Treasury bond. And you can see that since 2020, interest rates have steadily been going up. And right now, it's getting close to cracking a 5-year high. It's knocking on the door of 5%. In fact, I think yesterday it actually hit like 501. Now, I can promise you that as much as President Trump watches the stock market, like a hawk, and I think he's playing games quite a bit, by the way, with these tariffs. I think he's using these tariffs as kind of like a ballast in a hot balloon. He threatens a bunch of tariffs that are going to take effect in a few months, and that's his ballast, right? And in the event that the market doesn't like it, he can always throw that ballast overboard, and the market will go up again. But again, different topic, different video. But by doing that, he can, kind of dare I say it, kind of manipulate the market, or at least, influence the market. But he's more concerned with the bond market. I mean, listen, Donald Trump has been a businessman his entire life. He understands finances. He understands interest rates. But again, different topic, different video. Okay, so if you've been living under a rock and you haven't been watching, my videos, you're very well aware that since 1913, the creation of the corrupt Federal Reserve, the U.S. dollar's buying power has been going down steadily the entire time. And since 1913, the U.S. dollar has lost 98% of its buying power. And at some point, the dollar is going to be completely worthless. Hence, my mantra on this channel: get your money out of the bank, acquire gold and silver, and establish streams of passive recurring income. And I'll throw a fourth one in there: buy Bitcoin. Okay, so there are always clues. There's always breadcrumbs leading you to the next potential black swan event. And one of the clues that's pointing to a disastrous bond market, a disastrous underlying fear out there in the market, is the level of money market funds. Now, in times of uncertainty and in times of chaos, what do people do? They run towards safety, right? They sell their risk assets. It's what they call a risk-off event, right? They run towards safety. And one lifeboat that people will use during these times of chaos are money market funds. People just go to cash, right? And they say, I'll just park it in cash and I'll wait for the drama to be over and then I'll look for opportunities. Well, this chart shows you the increase in holdings in money market accounts. This is money that's just sitting idly, just kind of hanging around and just trying to preserve their money. And right now, money markets stand at over $7 trillion in money market accounts. Here's a more dramatic chart showing you that increase. But look at what has been happening since 2023. Just a steady hockey stick move up. And along those lines, it's not a coincidence that gold is making a new high. Here's a 20-year chart on gold. And as of today, as I'm recording this, it is at $3,307 an ounce. So the source of my concern is all about the bond market, and you really need to start paying more attention to it. The stock market is a pittance compared to the size of the bond market. But no one wants to talk about the bond market. People think it's a boring topic. Well, you better pay attention to it because it could dramatically affect your life. If the global bond market unravels, then you better start prepping real fast. Now, I am serious about this. I've been doing my best to make sure that my audience is prepared for these kind of events so that you're not victims and we can actually even benefit from it. Okay, so I talked to you about how the bond market in the US had a very poor performance. People didn't want them, but this is a global phenomenon. This is where it really gets scary. Now, listen, I know this is a complicated topic. And I've done my best to try to, boil it down to its essence so that you can kind of conceptualize what's going on. And I spent almost 4 days now gathering all of my evidence and trying to find a way to give it to you in a way that you can understand. Now, the country I want you to watch is Japan. Japan could be the spark that ignites a global financial disaster. Now, I want you to bear with me here for a second, okay? Because I had about 20 pages of data on Japan, and I will confess I did use AI to help me, digest it for you. I plugged in all of my notes, all of my data, and I instructed AI to give a nice short presentation of my notes. So what I'm going to do here is I'm going to show you that very short presentation that I created through AI talking about Japan. And again, please, it's only like 4 minutes long. Just watch it all the way through because this is important stuff, guys. Then at the end, I'm going to wrap all this up for you and tell you exactly what you should be doing right now. So let's take a look at that presentation.
For decades, the Japanese government bond market was a symbol of stability. However, this perception of safety is now crumbling. Japan carries an immense national debt, exceeding 250% of its GDP. The month of May 2025 witnessed an alarming surge in Japanese bond yields. The 30-year government bond yield soared to a record 3.185%. Similarly, Japan's 40-year bond yield touched a record 3.6%. Recent government bond auctions revealed a shocking lack of demand from investors. The auction for 20-year government bonds saw the weakest demand since 1987. The bid-to-cover ratio plummeted to levels not seen since 2012. These rising yields signify rapidly growing investor fears about Japan's sovereign credit outlook. The yield curve has steepened considerably, indicating a rising term premium. Investors are now demanding much greater compensation for the risk of holding Japanese debt over longer periods. This is the market's way of pricing in a future fraught with economic uncertainty. The government's capacity to manage its vast debt is now being openly questioned. Japan's financial future appears increasingly unstable. The bond market's distress signals are clear. Confidence is collapsing. The Bank of Japan now finds itself in an extremely unenviable position. Governor Kazuo Ueda faces the monumental task of navigating this crisis. If the BOJ raises interest rates, it could help support the weakening yen, but increase debt servicing costs. Maintaining low interest rates risks further destabilizing Japan's bond market. Governor Ueda is attempting a delicate and gradual exit from ultra-loose monetary policies. The market's recent violent reactions suggest this transition is proving treacherous. The BOJ's options are severely limited and none are particularly palatable. Japan's financial markets may well represent the painful endgame of an unprecedented monetary policy experiment. The volatility in Japan's bond market is sending shockwaves across international debt markets. The U.S. Treasury market, due to its size and liquidity, finds itself particularly exposed. Japan holds approximately $1.13 trillion in U.S. Treasuries. Recent data reveals Japanese institutional investors have been divesting from U.S. Treasuries at an alarming rate. In a single recent quarter, they sold off $119.3 billion worth of these securities. This represents the steepest decline in their holdings since 2012. The motivations behind this sell-off include repatriating funds to cover domestic obligations and generating dollar liquidity. As Japanese domestic yields rise, the attractiveness of the carry trade diminishes. A substantial carry trade unwind could lead to massive capital flows returning to Japan. This repatriation could cause considerable volatility in global currency markets. Emerging markets, significant beneficiaries of Japanese capital outflows, could face severe adverse consequences. Global asset prices, particularly in the US and other developed markets, could face significant downward pressure. The surge in Japanese bond yields amplifies the underlying credit risk associated with the government's massive debt. Japan is now confronting significantly more expensive borrowing, challenging its long-term fiscal health. The government must find a credible way to restore confidence in its fiscal management. This likely means implementing significant restraints on public spending or enacting substantial tax increases. The financial strain is not confined solely to Japan. The U.S. Treasury market has shown concerning signs of fragility. An auction of 20-year U.S. Treasury bonds witnessed weaker than expected demand. The yield on the U.S. 30-year Treasury bond recently breached the 5% threshold. Moody's recent downgrade of the U.S. debt rating has intensified investor skepticism. Many investors remain unaware of the true scale and potential global ramifications of this bond market crisis. Rising long-term interest rates globally threaten the viability of the traditional 60-40 balanced investment portfolio. The next phase of financial instability may be driven by weaknesses in sovereign debt markets. The turmoil in the Japanese bond market necessitates a reassessment of fixed-income investment strategies. Abandoning bonds entirely for equities introduces substantial new risks. Currency markets are poised for increased volatility. Governments might resort to allowing inflation to erode the real value of outstanding debt. Prudent investors should consider increasing exposure to real assets like commodities and dividend-paying companies. Some investors are exploring alternative solutions like structured notes and Bitcoin. The surge in Bitcoin's price suggests a reconsideration of it as a hedge against sovereign default risk. Active traders and institutional investors will find both significant risks and potential opportunities. Vigilance and adaptability will be paramount in navigating these uncharted waters.
So at some point here, the next big buzzword in the news is going to be the yen carry trade. I've done videos on that. I won't go over it here. I just covered a portion of it in this presentation. But let me just emphasize that Japan is the largest holder of U.S. Treasuries, and they're having their own economic issues. And at some point, they're going to have to defend their own currency by selling U.S. Treasuries. And listen, Japan is an ally of the U.S. They're a friendly country. So if they start selling our U.S. Treasuries, it's not because they want to. It's because they have to. They've already stopped buying our bonds. Pretty soon, they're going to start selling our bonds aggressively because they have to. Now we have the countries out there who are not friendly to the U.S., namely China. Now, the BRICS alliance and the Asian alliance have already been attacking the U.S. dollar. The primary mission of the BRICS alliance is to destroy the U.S. dollar. They want to destroy America's dominance in the world as world reserve currency. So they're making a concerted effort to destroy the U.S. dollar. And one of the ways they will do that is by dumping U.S. Treasuries. This is where I think it'll happen. It'll be a concerted effort. It will happen all at once. It's not going to be a dribble. They want to get the maximum bang for the buck. Pardon the pun. At some point, there's going to be coordinated selling of U.S. Treasuries. And when they sell those Treasuries, all those U.S. dollars come back to America. And what does that create? Hyperinflation. So that's the message I'm leading to here, right? Is that this bond event will lead to hyperinflation. As a matter of hyperinflation. It will be Weimar Republic type inflation. Remember those images from the Weimar Republic where people are taking wheelbarrows of Deutschmarks to buy a loaf of bread? If you think that can't happen in America or Britain or Australia, you're wrong. It absolutely could happen. And I don't want you to be a victim of it. So what should you be doing? You should be getting your garbage fiat currencies out of the bank, taking some of that garbage fiat currencies and acquiring gold and silver and establishing streams of passive recurring income. And if you want to learn about some of those passive income streams, shoot me an email. We'll get you signed up to the Hayden WhatsApp group. It's free to join that group. And in that group, we have people from all over the world. Matter of fact, I'm making a push here. I'm trying to acquire, I'm trying to expand the membership in the Hayden WhatsApp community. And there are some countries that are not represented. Is there anyone out there watching this from Sweden? Come on, I'd like to get, Sweden represented in the group. Now, let me just finish up by saying, listen, I'm confident that this event is going to happen. I just don't know when. But the warning signs are there. So you have time here, because I'm warning you, to get prepared, to be ready for it, or at least to recognize it when it happens early so that you can act quickly. Please like, subscribe, and ring that notification bell. Ed Anderson, live from Minnesota, signing out.
Copy that.